before the markets opened, we're riding high, share price higher. And then you really spelt out to investors the focus is still growth here. Profitability, you could pull some different figures, different chains, turn it on, but for now, growth is where it's at. How do you ensure that you show that you're disciplined about the growth and convert the investor base to liking it?
Yeah, I think one way we show it is to get to profitability, which we are profitable in our U.S. bike business. So we got to profitability, we are still profitable with that business, and now we are investing in new future growth drivers, international, the UK, Canada, Germany next month. We're investing in new categories with our treadmill, we're investing in our digital business, new content facilities, both here in New York and in London. So these are investments that we're excited about, but our core business is profitable. The headline coming out of this morning, to your point, Caroline, triple-digit top-line growth and single-digit EBITDA loss, and closing the losses from Q1 last year. So we're feeling great about not just the prioritization of growth, but for us, it's also prioritizing profitability. It's not an either-or for this business because the fundamental model is so gorgeous.
So there's still questions, though, of how you achieve that. I mean, as a public company, you know that Wall Street analysts can be sort of relentless in asking for more and asking for something new. We have an exercise bike, we have a treadmill. What type of products and what type of services do you have planned to sort of expand on what you've already built?
Well, it's a good question. We have a lot in R&D, and we have a lot of things planned in the coming years, and we're excited about it.
And you can tell us all that, right?
Yeah, exactly. But to be honest, we don't need, I mean, our core bike business is profitable. Mm-hmm. It will be profitable over the next couple of years in the UK and Canada. And our tread business is subscale from a manufacturing perspective, so it has lower margins. But as it gets to scale, the margins and the unit economics in that business go up as we get the cost of goods sold down through manufacturing scale. So we don't need to launch more products or more platforms or more geographies to that point to get to profitability. We may choose to invest in those things over time, but it's not something needed for profitability.
Do you have to lower prices, or we've got free trials being offered? How fierce is competition, and how hard is it to ensure that you win the scale in these new markets such as Germany? Yeah,
for better or worse, right now we don't feel like we have a true competitor, a like-minded competitor, as it were, a tech-based, well-capitalized company. So it's always been a question of should you lower the price on the Peloton bike? I founded the company with my co-founders 7.5 years ago. It's been incredibly academic to think about lowering the price. When you're doubling the company in size every year, including last quarter that we announced this morning, 103% top line growth, it's somewhat academic to think about lowering the price when you're making them, or when you're selling them as fast as you can make them at the current price point, right? So we feel pretty good. The value that our members see when they buy one, and they can buy one for $58 a month, and then you would divide it by 2 because your live-in partner also rides. So that's $29 a month for the hardware, and then the $39 a month for the subscription. But for a household, that's less than $50 per adult for unlimited, fantastic boutique fitness classes at the best location, with the best bike, with the best software and the best instructors in the world. It's a pretty good value proposition at the current price point.
There's still, though, this big hardware component to your business, getting that physical bike into the hands of people. Not only are you talking about a price point that is high for some people, you're also dealing with people who maybe have space constraints, particularly folks who maybe live in a city like New York. When you sort of look at your apps and you look at some of the services that maybe don't necessarily require the hardware purchase, do you think that could become a bigger and more important part of your business?
It could be, and if it does, I'm excited about it. We have a fantastic new head of our digital business named Karina Kogan, and I think she's going to surprise people with that business. To your point, the platform, we are platform agnostic with our content. So if you are one of the 34 million people with a treadmill in your basement today, Americans, 34 million, and then, or bikes, I think there's 15 million bikes in homes today. You don't need to buy our hardware. Download our app, throw it up to your 60-inch television screen in your home gym or your basement, and consume our content, take our classes tomorrow. So we are excited if that becomes a big deal for consumers.
Interestingly, about the infrastructure or the hardware requirement, you've been making some acquisitions, some interesting ones to either make future products built in-house more an easier thing, or manufacturing to own the supply chain. Are you going to continue to do that? And why do you need to do that? Sort of Apple doesn't do it.
Yeah,
Foxconn.
we don't need to do it. That's a good point. Apple does not own Foxconn. We decided, nor do we own or we are interested in owning our contract manufacturers for the tablets as well. So we have similar manufacturers to Foxconn making our tablets. That is a very mature industry, and we have very mature contract manufacturing partnerships on the tablets. For the bikes and the treads, there's been less investment in that category over the last 20 years. You know, Foxconn is an incredibly well-capitalized business, as you can imagine. For us, we bought one of our two core bike manufacturing partners. We're excited to help them invest.
This is Tonic you're talking about?
This is Tonic, exactly.
Okay.
For scale, over time, it will give us structural cost advantages if a competitor does come into our category. So we can make better bikes faster at more scale than the industry's ever seen, quite frankly, and we're very excited about it. We're also excited about our existing other contract manufacturer. We will always be dual sourced for all sorts of reasons, so we're excited about that acquisition. But Caroline, to your point, we bought a music platform last year. We bought the contract manufacturer. We bought this, call it an acqui-hire for hardware and software engineers out in the Valley, Gossamer a couple months ago. That's an incredible group of software engineers that we're very excited about. We're going to be opportunistic. We're going to be smart. We will use M&A where we think it's smart, but 90+% of our growth is going to come from organic investments from the proceeds of our IPO last month. We now have a $1.4 billion balance sheet, and we look forward to investing, as per our earlier conversation, in future growth drivers.
So that brings us back, though, to profitability.
Yeah.
I mean, in the past, a lot of companies have sort of gotten pretty long leashes to make those investments, and investors are willing to go along with the ride as long as, no pun intended, as long as that revenue growth was there. It seems that in recent months, there's been a somewhat shift in investor sentiment, and they want to see not only that revenue growth, but really that profit growth. Do you think that once you start to get a little bit more competition from bigger players in this space, or maybe folks that aren't even in the space right now, do you think that investment, the money you have now and the investments you're making, are going to be enough to fulfill those dual roles?
100%. It's a great question. We told our investors, we'll tell everyone today, we are fully funded based on the proceeds of our IPO, so we can make the investments, we can get to profitability. I said this morning on the earnings call, profitability for us is a managed outcome. If we pulled back on growth, we could be profitable tomorrow. We don't think that's a smart trade. We do think, as we have a 7-year head start on any competition. We might get 8 or 9 years, but we probably aren't going to get 15 years. So for us, it's a land grab. We want to get to as many markets with as many category-changing technology platforms as possible. We have the bike, we have the tread, we will have future products in the coming years, and we're very excited about those investments.